Hello, this is the Chart Profit video, approaching 3 hours into the trading day on the 12th of January. This from the pre-open. We're looking at the E-mini S&P. 2-month controlling price moved to this level, 26.88 at the end of last year. All subsequent value areas here, etc., all printed above that level, which is strong price location. And since that point we've seen 1, 2, look at the green at the top there, 3, 4 instances of aggressive buying. This is aggressive, effective buying. Market moving higher, buyers remain in control. We see this level here as important support, so price below 26.88, first sign of long-term weakness. You can see on the pulse chart here, the spider, the green bars in this rally indicating buyers active, significant buying, and on the spider chart, local point of control migrated up to 267 at about this point here. As we know, that migration often precedes a directional move, and then we saw nothing but buying. So pretty healthy looking pulse chart with the breadth indicator in the middle, green and supportive, and price momentum above zero and currently heading higher. Potentially, if this indicator turned down from here, it would create a little kind of negative pattern, in as much as the price oscillator here would be diverging with the price action, so higher high, lower high. Until that happens, there's no cause for concern on this pulse chart. So here is the current spider chart. Russell 2000 ETF IWM playing catch up at the end of this week. FTSE 100 has closed at a new high. UK FTSE 100 been oscillating for many months around 74.13. 18-month point of control migrated to that level in here somewhere. This price action here, printing time below that level, looked like a problem at the time, but it rebounded back above that level pretty quickly and has actually come higher at quite a pace. German DAX is lagging here, the 18-month at this level, just above 13,000. Price action or time spent underneath that level would be a sign of weakness, and obviously it's the laggard at the moment amongst the charts we've just looked at. Looking at the sentiment, as we know, the past few weeks there's been many signs of over-optimism, overheating in these indicators. This is my version of the Ridex assets ratio. At this point, at the end of last month, it reached 22.27. That's the highest ratio in the database. This is the public poll from AAII. Data in this week shows that the bulls percent fell to 48.7 this week. That's down from 59.8 the previous week. That was a 7-year high in the bulls percentage. And the bears, they jumped to 25.1% from the previous week's 15.6, and that was a 3-year low. Just highlighted here the net position, that's the bulls minus the bears. It's down this week from the previous week's 44.2, and that was the highest since April 2004. This is the Investors Intelligence poll. Bulls percent higher this week at 64.4. That's an extreme reading, really extreme reading. Bears percent was lower at 13.5% this week. That's the lowest bears percent as far as I can tell since September 2014. So the net there, bulls minus bears, at 50.6. That's the highest since 1987. So we're seeing, as I said, some pretty extreme readings in these numbers. Very, very bullish readings, and therefore from a contrarian perspective we see some overheating in these numbers. This is data from the Lipper US fund flows. They reported equity fund inflows, including ETF, of $12 billion in the week to the 10th. This data has been very volatile recently. I'll go into details here. And we note that 3 weeks ago there was a massive outflow. I called it a single week outflow of 22.2 billion. The black line here is the 4-week flow number. That's the net flow. It's actually just turned positive at 5.5 billion. But 3 weeks ago, again, that reached here a negative 33 billion. And we said at the time, that being the lowest since February 2008, that the 4-week flow number, as extremely low as that, usually marks market lows rather than tops. And at the time we said that that put this indicator firmly at odds with other sentiment readings we were seeing at that time. This indicator now heading higher, but a kind of neutral reading at the moment. Looking here at the recent comments regarding the bonds ETF TLT, and I wrote early last week that on a 30-minute basis the 15-month controlling price had migrated to 126.66, and I said that if price remains below this level it could be a negative, and we saw TLT falling back from that point, so actually declined to its lowest level since October. So this isn't good price location. Much prefer to see time, preferably a higher low above that 15-month at 126.66. Possibility that that could migrate lower, and we know that that can change the dynamics in the market. But the big level down at 119, that's the long-term support. That's the major controlling price. But currently this isn't strong price location for bonds. If we did see a recovery and we saw this sort of price action back above that point of control, I think that would probably be a negative indication for equities. The major controlling price on USO, the oil fund, recently migrated back up to 1141 here, and when it did that, we said that often precedes a directional move, and from there it's been higher. Seeing the highest price on this chart since I think late 2015 right now. Okay, let's finish by talking about the currencies, the dollar and gold. And this is the gold ETF, GLD. The major migrated back to 120.90. It's actually been moving around. It shifted up to that level in here somewhere. We saw the decline after that with price action below that level and some time around 119, and we saw the point of control shift back down, and then just in here back up to 120.90. It's a pretty bullish pattern when the controlling price falls and then rallies back and we see price above it. So gold right now in a really strong price location here, and as we've discussed, what kind of confirmed that bullish looking chart for gold was the pretty negative looking chart for the dollar index, which fell below its major at this point here. That's long-term weak price location. We saw a rally back from the September low. I did say in here somewhere that until the index got back above and printed some time above 95.50, I wouldn't make any assumptions about a long-term low being in until that happened. And then what happened from there is a really weak pattern when it went back down and actually broke back below the halfway point off the September low. So the halfway point from this low to this high, we've talked about this many times, this pattern. Here's the halfway point, and we've now broken back below it, and as I said last week, that often indicates that this low will be tested, and that's what it looks like at the moment. I've called this a key chart for a while. This also inversely correlated with gold. We're looking at the dollar yen chart. So here's the major at 113.70. It's remained there for a while, and we've seen probes into that level here, here and here, and twice in December we saw very clear resistance at that point. We're now back down to the 2-year here. So recently we've been doing this. Price below this level down here would be weak price location, and you'd see, I think, gold heading higher if we see price action below 111.30 on this chart. And we are seeing kind of confirming negatives for the dollar here in the Euro FX chart, breaking out to a new high for this move above the September high back over here, and also for the pound chart here as well. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.